Welcome to Griffonomics. Every time you ask an artificial intelligence to, write an email or summarize a document or uh, generate an image, you are basically burning physical coal.
Right. Or splitting physical atoms.
Exactly, splitting physical atoms. Because the AI revolution isn't happening in the cloud, it is happening on the power grid. And right now, the grid is, well, it's breaking.
It really is. I mean, you have this collision between digital ambition and physical reality, and it's basically the defining economic bottleneck of this decade.
Yeah, you've got these hyperscalers, the massive tech companies, and they are just desperate for constant, uninterrupted power.
And the problem is wind and solar are, intermittent, and traditional nuclear takes like 15 years to build. So the market is screaming for a solution that provides clean baseload power, but on a much, much faster timeline.
Which brings us to the core of today's deep dive. We are looking at Oklo Inc. This is a company stepping directly into that void, promising to solve the AI power crisis with next-generation nuclear energy.
But the stakes here are, they're wild. This is a story of massive technological ambition colliding with extreme financial and execution risks.
Just to set the stage for you, Oklo is currently trading around a $10 billion valuation. But, and this is the crazy part, they generated exactly $0.00 in commercial revenue for 2025.
Yeah, not a single cent from selling power. Their income essentially consisted of $29.1 million in net interest and dividend income.
Wow.
Which was generated entirely by just parking their massive cash reserves in the bank.
Okay, let's unpack this. They generated literally $0 commercially.
Zero.
A $10 billion valuation for a pre-revenue company. I mean, how do they justify that? And more importantly, how are they paying for this massive ecosystem they're trying to build?
Well, to understand why the market is pricing them that high despite having zero revenue, we really have to look at how they are completely dismantling the traditional nuclear business model.
Right.
Historically, the legacy standard in the nuclear industry has been for engineering firms, think like Westinghouse or GE, to design massive, complex light water reactors.
And then they sell those to utility companies.
Precisely. They sell the designs, and then the utility company is the one who bears the massive burden of construction costs, navigating the 15-year licensing process, and, dealing with the inevitable cost overruns.
So the traditional nuclear companies are essentially just architects and equipment vendors. They drop the blueprints and the reactor vessel on the utilities desk and basically say, good luck, pay us our fee.
Exactly. But Oklo is throwing that playbook completely out the window. They're operating under an independent power producer model, specifically a build, own, and operate model.
Okay, so they aren't selling the reactor.
Right. They are not selling a reactor to a utility. They are acting as their own utility. They plan to sell the actual electricity and heat directly to the end users.
Like those AI data centers.
Exactly, via long-term power purchase agreements or PPAs.
Which fundamentally changes the economics. I mean, if you aren't selling the reactor, you have to build a completely vertically integrated ecosystem to support it.
You do. And they are building it across three distinct pillars. First, there's the power pillar, which centers on their small modular reactors called Aurora powerhouses.
Okay, the actual reactors.
Right. Second is the fuel pillar. This includes their A3F fabrication facility and an incredibly ambitious plan to recycle used nuclear fuel.
Oh, wow.
Yeah. And third is isotopes, operating through a subsidiary called Atomic Alchemy.
Wait, what do they do there?
They basically extract high-value radioisotopes from the nuclear byproducts to sell for medical and industrial use.
So, to use an analogy, instead of selling the cow to a farmer, Oklo is selling the milk directly to the grocery store.
That's a good way to put it.
But to pull that off, they also have to build the dairy farm, grow their own proprietary grass to feed the cow, and then package the fertilizer byproduct to sell to a pharmaceutical company. It's a completely closed-loop system.
It is.
But I have to ask, isn't owning the entire vertical chain incredibly risky for a company that hasn't successfully commercialized a single reactor yet?
Oh, it drastically increases their upfront capital requirements, which we will definitely explore in a minute. But if we connect this to the bigger picture, from Oklo's perspective, vertical integration is the only viable way to insulate themselves from legacy nuclear supply chain shocks.
Because the supply chain is pretty bottlenecked, right?
Severely. There are only a few facilities in the world that can forge the steel for a traditional reactor, or enrich the specific type of fuel needed. By attempting to control the fuel, the reactor, and the byproduct, they are trying to build an impenetrable economic moat.
But that brings up the obvious next question. How does a company with zero revenue convince anyone, let alone a massive, risk-averse tech giant, to trust them with their multi-billion-dollar data center's power grid?
They do it by securing binding upfront commitments. And the massive strategic inflection point for Oklo happened on January 5th, 2026.
Right, the Meta deal.
Exactly. They entered into a binding agreement with Meta for a 1.2 gigawatt power campus in Pike County, Ohio. They are targeting an initial 150 megawatts of power delivery by 2030.
A 1.2 gigawatt campus is massive. That's the equivalent of a traditional full-scale nuclear power plant, just dedicated entirely to Meta servers.
It is huge.
But how does the funding actually work for something that won't produce a single electron of power for at least another 4 years? Why would Meta agree to that?
Because Meta is desperate for power, and they are willing to use their own balance sheet to basically jump the line. That's the brilliance of the prepayment mechanics in this deal. Meta is providing upfront capital specifically to fund fuel procurement.
Okay.
Because in the nuclear industry, fuel is an incredibly front-loaded cost. You have to buy and fabricate the uranium years before you actually turn the reactor on.
So Meta acts as the bank for the hardest part of the process.
Yes. By prepaying for the fuel, Meta deeply de-risks the initial project financing for Oklo. More importantly, it acts as tangible, undeniable proof of counterparty commitment.
So they can take that to the bank.
Exactly. Oklo can take that binding agreement to commercial lenders and say, look, one of the biggest companies on Earth is literally paying us in advance for the power. Now lend us the money to pour the concrete.
Okay, so getting the funding lined up is one massive hurdle. But getting the United States government to let you turn on a brand new type of nuclear reactor is an entirely different beast.
Oh, absolutely.
Let's talk about the regulators, because back in 2022, the Nuclear Regulatory Commission, the NRC, outright rejected Oklo's earlier application.
Yeah.
They basically said, we don't have enough information to approve this. So how is Oklo trying to get around that roadblock now?
They've pivoted to a highly unusual dual-track regulatory strategy. The traditional NRC pathway is, notoriously slow, rigid, and primarily designed to evaluate those massive water-cooled reactors we built back in the 70s and 80s.
Right.
Oklo realized that pushing fundamentally new technology through that legacy system on the first try was just a losing battle. So they are leveraging Department of Energy, or DOE, authorization for their pilot assets.
Here's where it gets really interesting. So they're using the Department of Energy as a practice field. What's the difference between the DOE and the NRC here?
Well, the DOE owns and operates national laboratories, like the Idaho National Laboratory, and they have a distinct mandate to foster advanced nuclear innovation. Under DOE purview, Oklo can actually build and operate their initial facilities.
Like the first Aurora powerhouse at INL.
Yes, and their Groves test reactor down in Texas.
Which means they can temporarily bypass the NRC bottleneck just to get shovels in the ground.
Exactly. For the pilot phase, they get to build the machine, turn it on, and gather real-world operational data. The strategy is to take that proven, practical data and use it to streamline their commercial NRC applications later.
Specifically for commercial sites like the Meta campus in Ohio?
Right.
Let me push back on that, though. Isn't this dual-track strategy basically using the DOE as a sandbox to prove the tech, just hoping the NRC will wave them through later? I mean, they still absolutely need the NRC to sell power commercially.
They do.
What happens if Oklo builds these test reactors, gathers all this data, and the NRC still looks at it and says no?
That is a multi-billion-dollar question hanging over the entire stock. The NRC must ultimately approve commercial operations. There is no loophole around that.
So it's a huge risk.
It is, but the DOE pathway is a data-gathering necessity. The NRC requires rigorous safety modeling. First-of-a-kind technology really struggles with those models because, by definition, the safety margins are theoretical.
And regulators hate theoretical.
The NRC doesn't like theoretical at all. By building the test reactors under the DOE, Oklo transforms theoretical safety models into empirical, indisputable data. They are betting that hard, physical data will force the NRC's hand to approve the commercial sites.
And getting that approval means nothing if the reactors themselves can't be built efficiently. Which brings us to the actual physical engineering of the Aurora powerhouse.
Right.
We mentioned earlier that they are completely bypassing the traditional nuclear supply chain. Let's break down exactly how they are doing that, because this is where the physics gets, frankly, fascinating.
To understand Oklo's innovation, you have to understand the problem with legacy reactors. Traditional light water reactors use water to cool the nuclear core. But to keep water from instantly boiling away at those extreme temperatures, it has to be kept under immense pressure.
Like incredibly high pressure.
Yeah, sometimes 150 times normal atmospheric pressure.
It's basically a giant, highly pressurized tea kettle. And if that kettle bursts, you have a disaster.
Exactly. And to prevent it from bursting, you have to build containment vessels out of custom-forged, ultra-thick steel. And there are only a handful of factories on the planet capable of forging steel that thick. It takes years and costs a fortune.
So how does Oklo get around that?
The Aurora powerhouse bypasses this entirely by using a liquid sodium-cooled, metal-fueled fast fission design. Liquid sodium can absorb massive amounts of heat without needing to be pressurized. It operates at normal atmospheric pressure.
Which means they don't need the custom-forged 10-inch thick steel domes.
Right. Because there is no massive internal pressure threatening to burst the pipes, Oklo can use standard, off-the-shelf industrial stainless steel alloys for their plumbing and containment. That takes years off the construction timeline and radically reduces the cost.
Hold on a second, though. If liquid sodium is so great, why isn't everyone using it? I remember from, high school chemistry that sodium is incredibly reactive.
It is.
If it touches air, it catches fire, it explodes when it touches water. Why on earth are we using it to cool a nuclear reactor?
That is the engineering trade-off, and it's the source of a lot of market skepticism. Liquid sodium is highly reactive. If a pipe leaks and the sodium hits the air, you have a very difficult-to-extinguish chemical fire.
Which sounds terrifying.
The engineering challenge Oklo faces is designing a system where that sodium is perfectly sealed and isolated. They are basically trading the physics risk of high-pressure water for the chemistry risk of reactive sodium.
And then there's the fuel itself. Because they aren't using the standard uranium you find in older plants. They need something called HALEU, high-assay low-enriched uranium. What is that and why is it a bottleneck?
Well, traditional reactor fuel is enriched to about 3 to 5%. HALEU is enriched to between 5 and 20%. It allows reactors to be much smaller and run for much longer without refueling.
Okay, so it's more efficient.
What's fascinating here is that the global supply chain for HALEU is virtually non-existent outside of Russia, and relying on that supply is no longer politically or economically viable. Fuel is basically the biggest rate limiter in the entire industry right now.
So how does Oklo plan to get it?
2 ways. First, they are pursuing a joint venture with Centrus Energy to co-locate HALEU deconversion services right next to the planned Meta campus in Ohio.
Smart.
Second, and this is more radical, they are building the Tennessee Advanced Fuel Center, where they are actively proving they can recycle used nuclear fuel from older legacy plants into a proprietary strategic fuel supply for their own reactors.
Think about this for a second. They're trying to build a reactor out of standard industrial steel that can run on its own recycled nuclear waste. It is the ultimate upcycling project.
It really is.
But let's pivot to the harsh mathematical reality of paying for it all. Because building a vertically integrated nuclear ecosystem from scratch, funding test reactors, and developing a completely new fuel supply chain that has to be astronomically expensive. Let's look at the numbers for FY 2025.
The financial realities are stark. On one hand, Oklo boasts what analysts are calling fortress liquidity. They ended 2025 with $1.41 billion in cash and marketable securities.
That's a huge war chest.
And then right out of the gate in January 2026, they raised an additional $1.18 billion by completing a massive $1.5 billion at-the-market offering program.
An at-the-market, or ATM, offering basically means they are just slowly trickling newly created shares into the stock market every day, selling them to retail and institutional investors to raise cash. So after January, they're sitting on over $2.5 billion, but they're burning through it fast, aren't they?
Very fast. In 2025, they posted a $139.3 million loss from operations. A huge chunk of that was payroll and professional fees as they scaled up their engineering teams.
Sure, you need expensive engineers for this.
But it also included nearly $41.8 million in non-cash stock-based compensation. That number was up from just $12.5 million the year before.
Wait, $41.8 million just in stock-based comp?
Yeah, driven largely by the fact that their stock price surged, which makes the equity they hand out to employees much more expensive on the balance sheet.
And this leads us to the reality of the dilution engine. Because Oklo is using a build, own, operate model, they have to pay for the construction of the power plants themselves. But since they don't have commercial revenue yet, they can't exactly go to a bank and get traditional debt financing.
Right.
So they have relied heavily on the equity markets. They are printing shares like a central bank. Their outstanding Class A shares ballooned from roughly 137.7 million to over 160.5 million in just 1 year.
And that is the dark side of the owner-operator model. The equity markets, meaning everyday shareholders, are carrying the entire weight of this capital-intensive infrastructure build. Management is guiding for $350 to $450 million in investing cash flows for 2026 alone.
Wow.
And that is just to fund the initial asset deployment.
So if I'm a retail investor listening to this, am I just funding a $10 billion science experiment through endless share printing? I mean, they have zero debt, which sounds great, but deploying 1 gigawatt of capacity annually might cost up to $5 billion a year. They will have to keep diluting existing shareholders over and over to pay for this.
That's the risk you take on.
So what does this all mean for the immediate future? If investors are paying for progress with their equity, what exactly are they getting in 2026?
2026 is a defining year for catalysts. They have to prove they can execute. Oklo has set a very specific, highly aggressive target. They want to achieve criticality at their Groves test reactor in Texas by July 4th, 2026.
And criticality means the reactor achieves a self-sustaining nuclear chain reaction.
Right. It is the ultimate proof of concept for their physics and their engineering.
And what else is on the docket for this year?
Well, they anticipate booking their first ever commercial revenue in 2026 from the newly NRC-licensed Idaho Radiochemistry Laboratory, which will start selling those medical isotopes we talked about earlier.
Okay, finally some actual revenue.
Yes. And most importantly, they are moving to active project deployment, literally breaking ground for the first Aurora powerhouse at the Idaho National Lab.
July 4th, 2026 is right around the corner.
Mm-hmm.
And if they miss that deadline, let's bring back that detail about liquid sodium catching fire. If the engineering is as tricky as critics say and they fail to achieve criticality by their own self-imposed summer deadline, does the whole house of cards, including that massive meta prepayment, start to wobble?
This raises an important question about execution risk. It absolutely does wobble. The margin for error is effectively zero. Yes, the meta deal is a massive commercial breakthrough that proves demand. But true, large-scale electricity supply isn't expected for almost a decade. Investors are paying a massive premium today for cash flows that are years away. Any technical delay severely damages Oklo's credibility regarding that 2030 meta timeline.
And we also need to talk about what the insiders are doing, because there is a data point in the research that should make any investor sit up and pay attention.
Oh, the insider selling. Right. Ahead of this intense construction phase, it was reported that Oklo's founders and the CFO offloaded roughly $270 million in shares.
That is a staggering amount of insider selling. I mean, if the management team truly believes they are about to revolutionize the global energy grid, why are they taking over $250 million off the table right before they start pouring the concrete?
Well, that kind of insider selling, combined with the technical risks of liquid sodium and the looming threat of constant dilution, makes institutional investors very nervous. It suggests that even the founders are eager to lock in their wealth at the current $10 billion valuation, perhaps acknowledging the sheer mountain of risk ahead of them.
Which brings all of our sources together to land on the ultimate question for you, the listener. How do you value a company that is living a decade in the future?
The analyst divergence on Oklo is unlike almost anything else in the market right now. On the bullish side, you have analysts like Bank of America rating the stock a buy with a $127 price target.
Which is huge.
They view Oklo as the ultimate high-beta speculative play on AI data center demand. They see the meta prepayment as proof that the hyperscalers will force this technology into existence by throwing unlimited capital at it.
But then you look at the bearish analysts.
Yeah.
They are running discounted cash flow models that price the fair value of Oklo between just $9 and $11 per share.
Exactly. They are arguing the stock is currently priced beyond perfection. Because of the massive capital expenditure required to build these vertically integrated plants, free cash flow is expected to remain deeply negative until the late 2030s or early 2040s. Oklo is really the ultimate battleground between nuclear innovation and financial reality. To buy in at these levels requires believing that their multi-source fuel strategy, their unproven recycling technology, and their dual-track regulatory bypass will all execute flawlessly.
And not only execute flawlessly, but perfectly align with the timelines of incredibly impatient tech companies. You are essentially being asked to buy an expensive ticket for a train that won't arrive at the station of true profitability until 2040. Are you willing to wait that long, knowing that your individual slice of the pie might get smaller every single year as the company prints new shares to fund the journey?
That's the ultimate question.
Let's recap what we've learned. Oklo has a massive pipeline of potential power demand between 14 and 19 gigawatts. They have the hyperscaler backing with the binding Meta agreement. And they have fortress liquidity, sitting on over $2.5 billion after their January equity raise.
But they face a mountain of regulatory hurdles with the NRC, massive ongoing capital requirements that threaten severe shareholder dilution, and a commercial technology that is entirely unproven at scale.
Before we go, consider this. Oklo's entire $10 million valuation is tethered to a single fundamental assumption that AI computing will demand an exponentially increasing amount of energy forever. But what happens if major breakthroughs in AI hardware efficiency occur over the next 4 years? What if the next generation of microchips requires a fraction of the power? Oklo might finally fight their way through the regulators, build their massive supply chain, and bring their first commercial reactor online in 2030, only to find that the desperate energy crisis they were built to solve has already plateaued. Risk defined, portfolio protected.